As an income investor, majority of my portfolio is into those high yield covered calls ETFs. And then as soon as you go online or you talk about it to your friends or whatever, people around you, they always tell you, oh, your investments are going to go down. You're going to have NAV erosion. You should take that into consideration. It's not just about the income. The yields are high. So for some people, it's too good to be true. And these are still new products on the market. So some people don't truly understand them. And I wanted to make a video to talk about my personal top 5 picks. If I had to pick 5 income ETFs for long-term wealth building, if I had to throw my money into one of those 5 ETFs or all of these 5 ETFs, and then I could just go in a time machine, wake up in 10 years, these would be the 5 ETFs where I would be comfortable doing a such thing. This is obviously not financial advice. This is just my personal opinion as a passionate income investor. So this is what I'll be talking about in this video. Before we get into it, I just wanted to say thank you to everyone supporting my channel, everyone subscribing. The growth is crazy. I'm already almost at 3,000 subscribers and I'm sure it's going to happen before I can even see it coming. Thank you so much for everyone supporting, and I'm raising my cup of coffee for you guys. Decaf coffee, because I'm doing a little coffee detox because I've been drinking too much coffee as of lately. So the first ETF I would pick would be SPYI. So this is NEO's S&P 500 high income ETF. All that this one is the S&P 500 with covered calls on top of it. In terms of total return, you will be following the S&P 500. The upside will be capped since this one is a covered call ETF, and as we know, covered calls will always cap your upside in exchange for more income. But overall, the total returns of this one is pretty close to the S&P 500 itself. Since inception, it has been doing very well. It's a community favorite for a reason. The monthly payments are consistent, so they are aiming for around 1% a month, which gives you 12% annualized. Just on the data perspective, it's not for nothing that Warren Buffett says that he could outperform anyone just by throwing $1 million in the S&P and waiting for 5-10 years. As long as the economy of the United States stays strong in the next 10 years, I wouldn't be worried about throwing some money into SPYI. As we can see, the performance of SPYI since inception, it's up 45%. Compared to the S&P index, which is 65%. So it is lagging behind, but obviously it's a covered call ETF. So you'll be sacrificing a bit of upside for some income. On a YTD, you're up 7.5% compared to the S&P, which is up 8.5%. And then if we quickly look at their distribution, so they pay a monthly distribution. Their distribution rate is 12%. And like I was saying, their distributions are pretty consistent. So since the beginning of the year here, as you can see, the latest distribution was 51 cents. Then it was 50. When the market crashed in April, it went down to 46 cents. And the good thing about this one is that you will not see drastic fluctuations in the distributions. Then 50 cents, 51. If we look at the 2024 distribution calendar, same thing, very, very consistent. 2023. And that's the reason why I would be comfortable dropping some money to this one, is because it has some history. If we compare SPYI to VOO, which is the S&P from Vanguard, it is essentially side by side with it. It is just lagging behind, and that's where you see the gap of investing into covered calls, that your upside is going to be capped. So in the moments where the S&P has a big rally, you won't be able to get as much upside by investing into SPYI compared to directly into VOO. But as we can see, this one is essentially replicating the returns of the S&P 500. Second ETF I would throw into my time machine would be QQQI. This one is also from NEOS, but instead of being the S&P 500, this one is on the NASDAQ. So the NASDAQ, for people who are worried or they don't understand much about it, it is not necessarily a tech index, but it is anything on the US market that is performing very well and that is not in the financial sectors. Currently on the US market, everything that is doing very well is tech related, chip related, and AI related. So that is why the Nasdaq currently is so heavy on tech. But in the future, let's say tech dies down and, like, for example, biopharma or quantum computing becomes very big, then we might see the Nasdaq being very heavy on biopharma and on quantum computing. So that is why I would be comfortable investing into the Nasdaq in the long run. So thinking about something you would be comfortable throwing your money into and waiting 10 years, you also have to understand what you're investing into. I would be comfortable investing into the Nasdaq in the long run. We know that the Nasdaq is a very good option for long-term growth. It is obviously more volatile than the S&P, but in the long run, it has been a very good investment. Since this one is a bit more volatile and it's the same thing as SPYI, it is the Nasdaq with covered calls. You'll be getting the returns of the Nasdaq. On top of that, you'll be getting some monthly distributions. The distribution rate, as we can see here, is 14.5%. If we look at their performance since inception, this one has been doing actually very, very good. It is up 30.5% compared to the Nasdaq itself, 33%. So it's only 3% behind the Nasdaq. If you're an income investor and you want a good mix of growth and high income, this seems to be like a very good choice. And from the data here, it has been doing very well next to the Nasdaq itself. If we compare QQQI to QQQM, which is a Nasdaq ETF, QQQI from NEOS has been doing very good. even better than SPYI in terms of following the underlying. Here it is very close to QQQM and there is not a big gap. Even though QQQI is covered calls, this one doesn't cap the upside as much as SPYI, at least for the data that we have at the moment. So for now we have S&P, we have Nasdaq. A third pick that would be very interesting is GIAX. So this one is Nicholas Global Equity and Income ETF. What is this one? So this one is essentially covered calls on the total global market. So you're not 100% focused on the United States. So instead of being super US focused, this one is basically betting on the economy of the whole world. So in 10 years, as long as the whole world is still growing and the economy of the world isn't doing too bad, you should be fine with this one and you should be collecting consistent income, consistent growth. So here the fund objective is global equities plus options plus monthly income. Here, as we can see, the NAV of GIAX is up 12.5% since inception. I don't think that this is also considering the income in the returns. And most of the ETFs I'll be talking about in this video have stable distributions. So as you can see, this one has been paying 39, 39, 38, 38, 37, 34, 33, 34, 35, 36. So aside from these being good ETFs, what's important also is that the distributions are consistent. Let's say you wake up in 10 years and there was a very, very bad year in one of those 10 years. At least you know that your ETFs pay some lower distributions, but since they are consistent, they would still have been paying out a decent amount of distributions that would have allowed you to snatch some shares at a cheaper price during those bad years. If we compare GIAX with VTI and VT, which are both Vanguard total market ETFs, as you can see, GIAX here, which is the red line, is doing pretty well in terms of total return. It is very close to VTI and VT from Vanguard. I wouldn't be too worried about investing into this one, and since this one is the global market, it could really serve as a very good core position for an income portfolio. Then another one I would actually put in there would be YMAX. The reason why I would put YMAX is because it is very diversified and YieldMax is always coming up with new ETFs that they are adding into YMAX. So as time goes by, YMAX becomes more and more diversified. And at the moment, I think there's maybe 35 to 45 holdings into YMAX. So this is kind of like a concentrated version of the S&P 500. Out of the other quote unquote concentrated ETFs, YMAX is the one that has been performing better from the research that I have done. What is great about this one is that it pays a high distribution rate. It has great total returns. It is diversified, and as time goes by, they have the flexibility to keep adding more funds into this one. So it gets more and more diversified. So in my opinion, YMAX has a very good potential in the future. And as you can see, the distribution is pretty high. The latest distribution was basically 65%. So this really depends on the implied volatility of the market, since it is a concentrated version of the S&P or of the Nasdaq. It has less holdings. If the few holdings that are inside of YMAX portfolio aren't doing as well, or they're not as volatile, some weeks you will see lower distributions. And on the other side of the medal, on some weeks you will see some very high distributions. But what's very interesting is if you look at the total returns of YMAX, YMAX is the blue line, and it has been pretty much side to side with the Nasdaq. And in some certain periods of uptrend, YMAX has actually been doing a better job at capturing upside than QQQM, for example. That is because they do pay high distribution rates. When the market is doing very good, they're going to pay very well. Also, the fact that they have weekly distributions, so your shares are going to compound much faster than monthly distributions. I really like YMAX, and even though this one is a very high yield one, I think this is one of the best performers from YieldMax, and it's probably one of the most stable ones, and maybe one of the only ones I would be comfortable holding in the long run, just from the fact that they're very diversified and they keep diversifying as time goes by. If I had to invest into Bitcoin and I want income and I want something that is quote unquote safe and I would be comfortable holding maybe for the next 10 years, I would pick BTCI again from Neos. I really like the ETFs from Neos because they're very consistent. They're pretty conservative with their distributions. They don't pay too high distributions, and I think they want to be more on the conservative/consistent side. Yes, their investors will get less income, but their ETFs will be more stable, much more consistent distributions on a month-to-month basis. So it's easier for their investors to kind of forecast how much money they will be making over time as they keep reinvesting their dividends. So this one pays monthly distributions and has a distribution rate of 27%. It is much higher than SPYI and QQQI, obviously because the underlying, which is the Bitcoin, has a much higher implied volatility, so you will be able to extract higher distributions out of this one. When we look at the returns of this one, since inception, it is up 60%, and YTD, it is up 26%, so this one has been doing very good. The latest distribution had a rate of 27%, and similarly to SPYI, QQQI, and GIAX, this one has very consistent distributions, as we can see, 147, 139, 151, and then in April when they had a crash, it was a bit lower, but it was still paying a very good amount, 125, 133, 143, 157. And then if we look at the few 2024 distributions that we had, because this one is still a fairly recent fund, 1.12, 1.40, 1.45. So as we can see, this one pays very consistent distributions. And as the price of Bitcoin is going up, this one will keep paying more and more distributions. When it goes down, it will pay a bit less. They probably try to aim for distributions that are about 2 to 2.5% a month. Now, if we compare the total returns of NEO's BTCI with the total returns of the Bitcoin itself, so IBIT, as we can see and as we saw with the other funds, since this one is a covered call ETF, the upside is going to be capped. So you always will see a little gap between your covered call ETF and the actual underlying. So if you're fully into growth, then obviously directly invest into the Bitcoin. It is trailing behind the Bitcoin. It's not exactly matching because obviously covered calls is going to cap the upside, but I think it is doing a fairly good job, and it is actually doing a pretty good job at following the total returns and the price movements of the Bitcoin underlying. If we look at the YTD here, BTCI is actually performing IBIT. The reason why is because with covered call ETF is that you're going to be trading upside for some income, but when there is no upside, so when the market conditions are slightly sideways or flat or growing slowly, or when the Bitcoin is going to go down a little bit, then you will actually outperform with your covered call ETF. And this really depends on the market conditions and on the timing. Sometimes you will see better returns from IBIT, sometimes better return from BTCI, really depends on the market condition. But as of now, pretty cool to see that BTCI is actually outperforming the Bitcoin. So yeah, that was it, guys. So these are my current top 5 ETFs for long-term wealth building and long-term income. So just to give you guys a recap, for the S&P 500, I would go with SPYI. For the NASDAQ, I would go with QQQI. Then I would also have some GIAX for some global equity exposure, plus some income. For my more concentrated version of the S&P 500, I would go with YMAX, which is weekly distributions as well, so even faster compounding in my portfolio. If I would have to bet on the Bitcoin for the next 10 years, and I would have to do so through an income ETF, I would go with BTCI. So let me know in the comments, guys, what would you pick? Do you guys agree with this, or do you guys think these are bad picks, or do you guys think there would be better picks for different scenarios? If you made it all the way here, thank you for watching the video. Please leave a like if you enjoyed, and until next time, take care.